Hello everyone. Now let's talk about the types of stock, and we have two main stocks that we're going to talk about, which is the common stock and preferred stock. So the minimum that any corporation should have is common stock. But if they want to add the other kind of stock, then it's going to be preferred on top of the common stock. But you can never have preferred stock alone. So when only one class of stock is issued, it's called the common stock. Each share of common stock has equal rights. A corporation may also issue one or more classes of stock with various preference rights, such as preference to dividends. Such a stock is called preferred stock. So the dividend rights of preferred stock are stated either as dollars per share or as a percentage of the par value. So for example, we can say the preferred has a $4 stock, $50 par, which means that it pays $4 in form of dividends, or it can be said as preferred 8% stock of $50 par. So it means that it pays dividends of 8% out of the $50 par value, which is the same for $4. So common stock, preferred stock, they have different order whenever they take their dividends and their preferences. So as the name implies, preferred stockholders, they have preference. So whenever there are distribution of dividends, usually preferred stockholders would receive their dividends before the common stockholders. So the common stockholders would take whatever is left. And of course this applies also for liquidation. If the company is going through liquidation, the preferred stockholders would receive the distribution of the assets before the common stockholders. So the preferred stockholders, they have preference over the common stockholders. But remember, preferred stockholders, this is an option that some corporation would have. Not all corporations have preferred stock. So the payment of dividends is authorized by the corporation's board of directors. When authorized, the directors are said to have declared of dividends. Cumulative preferred stock has a right to receive regular dividends that were not declared paid in prior years. So in other words, let's say the company decided, or the corporation decided not to distribute any dividends this year. So the preferred stockholders, the common stockholders, would not receive any dividends in this case. But the following year, the company decided to declare, let's say, $10,000 of dividends. So for the case of cumulative preferred stock, they are going to receive the dividends for the current year in addition to what they missed for the prior year where the corporation did not declare any dividends. So that's actually a good feature for preferred stock, that they can accumulate whatever they don't receive in a specific year. And that's why we call it cumulative preferred stock. On the other side, if the preferred stock has a non-cumulative feature, then in this case, whatever is not declared, it's gone. So non-cumulative preferred stock does not have this right. So if you are investing in preferred stock, which one do you think would be better? I think cumulative would be better, because in this way you guarantee receiving your dividends every year, even in the years where the company would not declare any dividends. It's going to be accumulated, and you will receive what we call it in arrears. So in arrears is any kind of dividends that were not declared, but they have to be paid for the cumulative preferred stock. So cumulative preferred stock dividends that have not been paid in prior years are said to be in arrears. Any preferred dividends in arrears must be paid before any common stock dividends are paid. And you can see here, the common stockholders are usually getting what you call it the leftovers, because we have to pay the creditors first. We have to pay, or of course, like the interest for creditors. You have to pay the dividends for the preferred stock, and if it's cumulative, then you have to also pay any in arrears dividends, and then whatever is left is paid to the common stock. And in some cases, the company would declare enough dividends that would make the common stock dividends actually attractive. So sometimes it's higher than the preferred stock, and sometimes it's lower. Sometimes there's nothing enough for the common stockholders. So as you can tell, for common stock it's a little bit risky when it comes to dividends. But for preferred stock it's a little bit guaranteed, because you get to know that you're going to receive at least, let's say, 8%, if the preferred stock has this kind of dividends, stated dividends. And even in the case if the company did not declare any dividends, you know that it's going to be received in the future years whenever the company declares any dividends. So let's see this example. Assume that a corporation has issued the following preferred and common stock. We have 1,000 shares of cumulative preferred $4 stock, $50 par, and another 4,000 shares of common stock, $15 par. As you can tell, these preferred stock are cumulative. So if for any year they didn't receive any dividends, it's going to be accumulated, or in other words, we call it in arrear. So the corporation was organized on January 1st of year 1 and paid no dividends in year 1 and year 2. So we have 2 years here of dividends in arrear. In year 3, the corporation paid $22,000 in dividends, of which $12,000 was paid to preferred stock. How did we get this number? We'll see in the next slide. And the leftover, which was $10,000, was paid to the common stockholder. So in addition to dividend preference, preferred stock may be given preference to assets if the corporation goes out of business and it's liquidated, as I mentioned before. So in the worst case scenario of liquidation, preferred stockholders, they receive any kind of liquidation asset before common stockholders get any chance to get the liquidation values. So let's see how we got the $12,000. So the total dividends paid were $22,000. We had 2 years in arrears, year 1 and year 2, and the value of the dividends is 1,000 shares multiplied by $4, so we have $4,000 for each year. And then for the current year, year 3, we have $1,000 multiplied by 4, and that's the fourth $4,000. So I think the lines here are slightly shifted. This should be the 4,000 in front of each year. So we have two 4,000s for the dividends in arrear for year 1 and year 2, and for year 3 we have the third 4,000. The total of these is $12,000. So if we deduct the $12,000 from the $22,000, then it's $10,000, the leftover, that's going to be dividends available to the common stockholders. Of course, we know that we have 4,000 shares of common stock. So if we divide 10,000 by 4,000, then in this case each common shareholder is going to receive $2.50. So in this case it's a little bit less than the preferred stock holders, because the preferred stockholders, they receive $4. And on top of that, the preferred stockholders, they received $4 for the years where the company did not declare any dividends. So for year 1 and year 2, they still received the dividends for that. So let's see the journal entries for issuing stock. A separate account is used for recording the amount of each class of stock issued to investors in a corporation. So we have an account for common stock and an account for preferred stock. So assume that a corporation is authorized to issue 10,000 shares of $100 par preferred stock and 100,000 shares of $20 par common stock. The number of authorized shares is not really important for recording the journal entry. It's only important to have it as a footnote, just to let the users of the financial statement understand how many shares the company is allowed to issue. But what's important is the next bullet point, where the corporation issued actually 5,000 shares of preferred stock and 50,000 shares of common stock. As we said in the previous video, the number issued cannot be more than the authorized. So in this case, you can see that it's only 50% of what was authorized the company issued. So the journal entry would be, we're going to credit preferred stock for 500,000. How did we get that? It's 5,000 multiplied by the par value of $100, and that's 500,000. And then for common stock, the company issued 50,000 shares. It's $20 par, so multiply that together, and that's $1 million. The total of these on the credit should match the debit, and what we have here is debiting cash for $1.5 million. So the corporation received $1.5 million, and they credit preferred stock and common stock for $500,000 and $1 million. And then we have this simple note that says issued preferred stock and common stock at par for cash. So stock is often issued by a corporation at a price other than its par. So what we had in the previous case was that the company or the corporation issued the stock at its par value. In many cases, it's higher than the par value. So how we're going to treat the difference. The price at which stock is sold depends on a variety of factors. The main things are the financial condition, earning records, and dividends record of the corporation. Also the investor expectations of the corporation potential earnings power, and the general business and economic condition expectations. And you can see that in the stock market, the fluctuation of the stock price happens every day. So if stock is issued or sold for a price that is more than its par, we say that the stock has been sold at a premium. If the stock is issued at a price less than its par, then the stock has been sold at a discount. In very few cases, we find that the stock is issued at its par value, unless it's a private corporation. So large public corporations normally use a financial institution, such as a bank, to keep track of the stockholders. In this case, the financial institution is referred to as a transfer agent or the registrar. So let's talk about the scenario of a premium. So when stock is issued at a premium, in other words, at a price higher than its par value, cash is debited for the amount received, which is the actual selling price. Common stock or preferred stock has to be credited for the par amount. And remember, preferred stock and common stock, these are part of equity, and equity is usually on the credit. So whenever it's increasing, it goes up on the credit side. If it's decreasing, it goes on the debit side. The excess of the amount paid over the par value, we call it the paid-in capital. So we create a credit account, we call it paid-in capital in excess of par, and it would be credited by the difference between the amount of cash received and the par value. So let's see an example. Assume that Coldwell Company issues 2,000 shares of $50, par value, preferred stock for cash at $55. So you can see here the par value is 50, the selling price was 55, or the issuing price was 55. So the journal entry would be, I usually start with the easy part, which is crediting preferred stock based on its par value. And we have 2,000 shares multiplied by 50, and that's $100,000. We also know that there's an additional $5 for each share that was issued. So we take the $5, which is the difference between the 50 and the 55, and we multiply by $2,000. And that's equal to $10,000. So we call that paid-in capital in excess of par for preferred stock. So we have a dash here, preferred stock. The total of this, the 100,000 and the 10,000, is the cash value, which is 110. So we debit cash for the $55 multiplied by $2,000, which is $110,000. And that's how the journal entry is balanced. So when stock is issued in exchange for assets other than cash, which is in some scenarios we can see that. We see that an investor would bring land, building, equipment. The asset acquired is going to be recorded at their fair market value. Okay, so we see what is the fair market value of that asset, and then we record it in the journal entry. So what if this value is not clear, cannot be determined? Then we use the fair market price of the stock issued, and that's what's going to be used in the journal entry. So let's see an example. Assume that a corporation acquired land with a fair market value that cannot be determined. In exchange, a corporation issued 10,000 shares of its $10 par common stock. If the stock has a market price of $12 per share, then we're going to record the land based on the market price of the shares, which is $12 multiplied by 10,000. So we're going to credit common stock based on its par value, which is 10,000 shares multiplied by $10, that's 100,000. And then we are going to record the extra $2 paid in capital in excess of par. So $2 multiplied by 10,000, that's 20,000. The total of these two is the value of the land. Remember, the land, we did not know how much was the value of the land. So the value of the land is what was exchanged with, which is the value of the common stock based on the $12 market price. So that's why the land would be $120,000 on the debit side. The case of discount is not very common, and that's why we're not going to see the example for a discount. But Let's see a scenario where we are issuing stock that don't have par value. In some states, you can issue stock with no par value. So in most states, no par preferred and common stock may be issued. So when no par stock is issued, cash is debited and common stock is credited for the proceeds. We don't need to worry about paid-in capital in excess of par. But in some states, you're required to have a stated value. So if we have a stated value, we're going to have paid-in capital in excess of the stated value. So as no par stock is issued over time, this entry is the same even if the issuing price varies. So let's see an example for no par stock. Assume that on January 9th, a corporation issues $10,000 shares of no par common stock at $40 a share. On June 27th, the corporation issues an additional 1,000 shares at $36. So the journal entries would be straightforward based on the selling price. So we can see here on the first journal entry, we debited cash and credited common stock based on the 10,000 multiplied by 40. There's no par value to multiply with. We're just going to use the market price. So it's 400,000. Then when we sold it for a lower price, 36, we did the same thing. We debited cash and we credited common stock for the 36 multiplied by 1,000, and that's $36,000. So in some states, no par stock may be assigned a stated value per share, as I just mentioned. So if we are required to have a stated value, then we treat it the same way like the par value. The only difference, we call the account paid-in capital in excess of stated value. That's the only difference. So instead of saying paid-in capital in excess of par value, then we just call it paid-in capital in excess of stated value. I think this is not something too confusing, so just think about it. We have three different kinds. So if we have a par value, we just use the paid-in capital in excess of par. If we don't have par value and the state does not require us to have a state value, then we just use the market price and we don't need to worry about the paid-in capital. But if we are required to have a stated value for a no par stock, then we treat the stated value similar to the par value. So let's see this example. Assume that in the preceding example that the no par common stock is assigned a stated value of $25. So in this case, you can see that we have common stock, which is the 10,000 multiplied by 25, that's 250,000. The paid-in capital is the extra $15 multiplied by 10,000, that's 150. And then the total of these would be the amount of cash. So the cash is the same because the cash we cannot get around that. It's the amount of cash received, it's 400,000. When we issued at 36, we still issued the common stock at 25 multiplied by 1,000, which is 25,000. And then the additional $11, which is the difference between the 36 and the 25, multiplied by 1,000, and that's the paid-in capital in excess of stated value for $11,000. The total of that is the amount of cash received, which is $36,000 on the debit side for cash. So the only difference is that we replace the word par value with stated value. So let me stop here. In the next video we're going to talk about accounting for dividends, which I think is also very interesting.